Welcome to the Deep Dive. Our mission is always to shortcut you to being well-informed, and today we are opening the books on a true consumer staples bellwether, Procter Gamble.
Yep, we're dissecting their Q1 fiscal year 2026 earnings call, which dropped pre-market on October 24th.
And our job here is to really extract the signal from the noise.
Exactly. P&G delivered a beat on earnings and revenue, but, the market's initial excitement just vanished almost immediately.
It really did. So we need to understand why that intraday fade happened. What does flat volume mean for them, and how are they planning to fund their strategy with all this intense competition going on?
That's the core of it. So let's just start with the headline numbers.
Okay, let's unpack it.
Yeah.
P&G sailed past consensus expectations. Core, or non-GAAP, EPS came in at a strong $1.99.
Right, which beat the $1.90 analyst consensus by 9 cents. GAAP EPS was just a little lower, $1.95.
And revenue.
Revenue was also a slight beat. It came in at $22.4 billion, just a hair above the $22.2 billion consensus. That's 3% growth year over year. So on the surface, a clean sweep.
But the devil, as always, is in the organic growth details. What did we learn about the quality of that 3% revenue growth?
This is where the entire story pivots. So organic sales grew 2%, and here's the core issue the market just zeroed in on. That 2% growth was split right down the middle. 1 point came from pricing actions, and the other 1 point came from favorable mix.
Which just means selling more of their premium product.
Exactly. So if you do the math, that means unit volume growth was, it was flat. 0%.
Flat volume, that's the phrase that just haunted the day. We saw the shares pop, 2.4% to 3.5% in the pre-market?
A respectable pop, yeah.
But as soon as investors and analysts started digesting that flat volume number, combined with the fact that they just maintained their full-year guidance, that optimism bled away.
And P&G finished the trading day up barely 1/5 of a percentage point. That is a significant fade. It just screams deep concern about demand.
It absolutely does. When pricing and mix are the only things driving growth, it means you're relying on the consumer's willingness to pay more, not buy more.
Right. You're not expanding the basket size. Now, to be fair, what shielded them was their operational efficiency. It was phenomenal.
Okay, so how did that look?
Core operating margin was flat year over year, which, is pretty impressive when input costs are still volatile. And productivity improvements, this is huge. They contributed 230 basis points to profitability.
They are definitely running a tight ship. And adjusted free cash flow productivity was 102% for the quarter. So they're generating the cash, which they need.
Which they absolutely need, because that volume story feeds directly into the competitive battleground. Management, of course, framed these results as strong execution of their integrated growth strategy.
The usuals: superiority, productivity, portfolio management.
Right, all while navigating a, quote, difficult geopolitical and consumer environment.
But the data suggests that environment is fighting back pretty hard.
Oh, it is. If you look at the wider category consumption, the data shows that consumption in P&G's core categories actually decelerated throughout the quarter.
What?
And globally, their aggregate value share, so the total dollar amount of their sales, was down 30 basis points.
A share loss is always concerning for a market leader. Was this pressure? Was it widespread?
They admitted that only 24 of their top 50 category and country combinations held or grew market share. And this is critical. It signals that the most intense competitive activity is in the developed, high-profit markets.
So we're talking about the U.S. and Europe.
Specifically, the U.S. and Europe.
Yeah.
And they didn't just leave it vague. They gave specific call-outs.
Why did they point the finger?
They pointed directly to U.S. fabric care and, even more specifically, U.S. baby care. They noted a huge ramp up in promotional activity from rivals, especially in that mid-tier baby dry section.
Okay, so that's the segment where affordability is key. And if competition is attacking with lower prices, P&G's volume is going to take a hit.
That's it, which brings up the obvious question.
Why not just match the promotions?
Yeah.
Why not fight fire with fire?
Because their strategy is just fundamentally different. P&G's response is what they call steadfast integrated superiority.
Right.
They argue that the answer isn't just matching promo dollars, which they see as a race to the bottom, but instead driving value through real innovation that makes their product undeniably better. They are betting that superior performance is the only sustainable path forward.
Okay, so let's break down that integrated superiority idea with the examples they gave. It starts with the product itself.
That's their innovation engine. Think about fabric care. They're rolling out the biggest liquid detergent upgrade in 2 decades right now with Tide's boosted formula. But the really revolutionary thing is Tideevo.
Tideevo, right. This is the one based on a functional fibers platform. That sounds technical. What does it actually mean for me doing my laundry?
It means they've changed how detergent interacts with clothes at a molecular level. It lets the detergent clean deeply without all the bulk of a traditional liquid. So you get superior cleaning in a much lighter, more sustainable form.
So it's a real step change.
It is. Tide Evo Free and Gentle has started its national expansion online, and here's the key part. In test markets, it is driving highly incremental category growth. It's bringing new money into the laundry aisle, not just stealing sales from competitors.
And that's exactly the premiumization they're aiming for. What about baby care, the area that's under the most pressure right now?
Even there, the response is innovation. They're launching new upgrades across all the Pampers lines, Easy Up, Swaddlers, Cruisers, and they're doing the first Factiva restage for that mid-tier baby dry line. They're trying to innovate their way out of the price war.
So superiority is the offense. How does that connect to their broader outlook? They're facing this intense pressure, yet they maintained all their full-year guidance. Organic sales growth is still pegged at plus 0 to 4%, and so is core EPS growth. I mean, if Q1 volumes were flat and they're warning about a promotional war in Q2, how is that full-year guidance not just optimistic spin?
That is the perfect challenge. They're maintaining guidance because they have these quantified, concrete buffers and tailwinds that are offsetting the pressure. And they're using that relief for investment, not just for margin.
Okay, so what flexibility did they gain?
A substantial amount. First, the negative impact from tariffs for the whole year was lowered pretty significantly, down to about $0.4 billion after tax.
Why was that?
Well, the administration granted exceptions for critical materials that can't be grown in the U.S., like eucalyptus pulp and psyllium.
Eucalyptus pulp and psyllium. That sounds a little random. Why are those so important to P&G?
It connects directly to their biggest brands. Eucalyptus pulp is key for paper products like Bounty and Charmin. And psyllium is the core ingredient in Metamucil, their digestive health brand. So getting tariff relief on those is a major win.
Got it. And they also got some relief on commodities.
Correct. The commodities headwind was lowered to about $0.1 billion after tax, mostly thanks to oil prices moderating. Plus, they now have an FX tailwind of about $0.3 billion.
So if you stack all that up,
You get roughly 20 cents of increased operational flexibility per share compared to what they were expecting before.
20 cents. That's significant. Most companies would just drop that straight to the bottom line and make investors happy.
And that is precisely the strategic difference here. Management was crystal clear that flexibility is not flowing to the bottom line. It's being intentionally and aggressively used to fund more investment in innovation and competitiveness.
Specifically in the US and Europe, where they see those huge growth opportunities.
Exactly. So maintaining guidance while diverting 20 cents of relief into strategic investment is central to their whole belief system right now.
And that investment is being fueled by a massive restructuring effort they detailed. We're talking about 7,000 roles.
That's right. The scale is staggering. It's a 2-year program to reduce up to 7,000 non-manufacturing roles, which is about 15% of that specific workforce. It's about streamlining the corporate structure and right-sizing their supply chain. They call it Supply Chain 3.0.
And the goal?
Up to $1.5 billion in COGS savings before tax. This restructuring is the financial injection that fuels their whole innovation strategy.
Let's talk about timing, because they did warn investors about Q2. Management said Q2 will be the softest growth quarter for the year. Why are they warning of even more deceleration after Q1 was already flat on volume?
Yeah, that's primarily a base period timing issue. They're lapping 2 huge spikes in orders from last year that were related to port strikes.
Okay, one in October and then the threatened one in January?
Exactly. Those spikes basically borrowed volume from the quarters we're in right now. They expect stronger growth to come back in the second half of the fiscal year, Q3 and Q4, when those base effects normalize and their new investments start to kick in.
And while North America and Europe are facing these headwinds, there were some impressive strengths elsewhere. Greater China, for instance.
Yeah, Greater China organic sales grew 5%. This turnaround is a really critical success story for them. It's proof that their model can work.
What's driving it?
A complete overhaul of their go-to-market model, better distributor incentives, and, superior local innovation. For example, their premium body wash, like the Olay line, grew 80% online, and baby care was up 20% in China.
And Latin America is still a growth engine for them.
Absolutely. LA was up 7% organic sales, led by Brazil, which grew nearly 30%. These regional successes give them the confidence and, frankly, the momentum to offset the tactical softness in developed markets.
The call also got into this interesting philosophical debate about consumer psychology. P&G really pushed back on the idea that consumer choice is purely about affordability.
They did. They argue it's about sharper value. Their definition of sharper value is integrated performance over price. They're trying to fight the narrative that everyone is just trading down.
And they brought data to back that up.
Two critical data points. First, private label shares in the U.S. are actually declining right now, down 50 basis points.
That is a huge counterpoint to the everything is trading down narrative we hear so often.
It is. And second, P&G's sequential absolute value share in the U.S. is actually improving month over month. Their point is, when they offer a truly superior product, consumers will pay for it.
Finally, let's touch on the future of shopping, agentic commerce. So AI or shopping prompts guiding our purchases. Management seem pretty bullish. They see it as all opportunity.
Right. They're not worried that an AI agent will just default to the cheapest thing. They believe success will still hinge on brand fundamentals. They're betting that the consumer, through their AI, will tell the agent, find me the best performing diaper for my baby's sensitive skin.
Or find me the best detergent for tough stains.
Precisely. So the agent is only as good as the product proposition it's selecting. And P&G believes their continued investment in superiority, like a Tideevo, will ensure they are the product the AI selects.
Okay, let's move to our final segment. This is not financial advice.
And we have to emphasize, this is purely for discussion and entertainment. P&G is highly reliant on its integrated superiority strategy. They believe that category growth will return to 3% because of premiumization, all funded by these massive restructuring savings.
However, that explicit warning about Q2 deceleration and all the competitive promotional activity in key U.S. categories, that presents a real measurable tactical risk right now.
It does. The pressure points they specifically named U.S. fabric and baby care suggest that competitors and value retailers are trying to capitalize on this weakness right now during the crucial holiday selling season.
Which brings us to our outrageous but plausible trade idea, the Tide versus Target spread trade.
The thesis is simple: tactical pain for strategic gain. Given the flat volumes and the promotional heat in U.S. baby care, the near-term environment really favors retailers known for aggressive private label and promotions.
So the trade is to go long P&G betting on the long-term superiority model, the $1.5 billion in restructuring benefits, and that full-year guidance to eventually win out in the second half of the year.
But you pair that with a tactical short position on a key retailer known for aggressive private label execution, someone like Target.
Right. Target, with its successful up-and-up baby care and home cleaning lines, is perfectly positioned to capture that value-seeking consumer that P&G admitted is pressuring their mid-tier categories in Q2.
Exactly. So you're betting on P&G's strategic investment overwhelming competitors by H2, but you short the promotional retail environment that's pressuring them right now in this soft quarter.
So to recap, P&G kicked off FY26 with a beat driven entirely by pricing and mix, but with flat volume. They're using cost efficiency and a massive restructuring, including up to 7,000 job reductions, to fund relentless innovation in the face of a really tough competitive environment.
The path is clear. Invest in innovation, cut costs everywhere else, and wait for the volume to come back in the second half of the year. But here's the final provocative thought for you to chew on. P&G has publicly quantified two huge growth opportunities. There's a $5 billion opportunity in serving underserved consumers in North America and a $10 billion opportunity in improving household penetration in Europe. Given the immediate need for volume recovery and the very specific investments they're making in the U.S. Tideevo, the Pampers restage, which of these huge opportunities, North America or Europe, will show the earliest and most measurable signs of being unlocked by this current wave of investment and restructuring?
A great question to end on. Thank you for diving deep with us today on The Deep Dive. We'll catch you on the next call.